How much cash value life insurance do you actually need? Hi, I'm Brandon, founder of the Insurance Pro Blog and licensed insurance agent, and that's the question we're going to tackle today. The fairly simple answer is as little as possible. Why? Well, when it comes to cash value life insurance, we are typically focused on the accumulation of cash value, and death benefit equals fees. So if we want to minimize the fees of a cash value life insurance policy, we want the fees to be as minimal as possible. So to be a little cliche, when it comes to cash value life insurance and cash accumulation, less is more. Think of it like this. For every dollar of death benefit you have in force, there is an amount in cents that you can contribute to the policy at a maximum in order to keep all of the tax favorable features of a life insurance contract. And if we want to maximize the cash value buildup while maintaining those tax favorable features, then we want to minimize the death benefit to the lowest allowable amount that will accommodate the amount of money we plan to put into the policy, and ideally have no more than that. And interestingly, in some cases, we can get so precise as to fuss over how much money and for how long do you intend to pay it. That tends to be a much more critical question for whole life insurance than would be universal life insurance. But it is something that we do look at when it comes to optimizing cash value life insurance policies. But what? What if you are looking to buy cash value life insurance and you need a certain amount of death benefit and it's simply not enough? The answer in this situation is you buy term life insurance. You buy a separate term life insurance policy to complement the amount of life insurance death benefit that you will put in force with your cash value policy. So, for example, if you decide that you need $2 million of outstanding life insurance in force, you've decided for whatever reason that you want to use cash value life insurance as part of your overall savings or retirement plan, and you come to us looking for the right life insurance proposal. We're going to ask you, quite simply, how much money do you want to contribute annually to your life insurance policy? Which is something you may not know at first, but we'll work together and figure out what the right amount is. And let's say after all of our discussions, you decide that $35,000 per year is the right amount for you to contribute to your cash value life insurance policy. The problem is that $35,000 planned premium going into your cash value life insurance policy will create a death benefit of just $650,000 if we're doing this the right way, which means you need an additional $1.35 million of life insurance. A term life insurance policy with that much death benefit should run you about $980 a year in this example. So you'll buy two policies, a cash value life insurance policy and a term life insurance policy to get you to the total $2 million death benefit target. But you might be wondering, couldn't we just increase the death benefit of the cash value life insurance policy since we have control over that sort of thing? And the answer is yes, we absolutely can. But it's a terrible, terrible idea. Why? Because an increased death benefit means increased fees associated with a cash value life insurance contract. In fact, in this example, a death benefit of $2 million over the $650,000 minimal death benefit we need to allow the $35,000 premium would be a 200% increase in outstanding death benefit on the cash value life insurance policy. This, unsurprisingly, will also create a 200% increase in the fees of the cash value life insurance contract, which will be monstrously destructive to the accumulation of cash value in the policy. It will absolutely blunt your rate of return capabilities. And just how much will it change your rate of return and accumulated cash value? I came with an example to share with you. This is an indexed universal life insurance policy with all the parameters that we've already discussed. It's got a $35,000 premium assumed, and the death benefit has been reduced to the lowest allowable amount to still qualify as life insurance and benefit from all of the tax favorable features of a cash value life insurance policy. Let's look at year 20. For paying $35,000 per year all the way through year 20, we will have accumulated a little over $1.2 million, and we will have achieved a rate of return slightly above 5%. This example illustrates a perfectly reasonable assumption about the accumulation of values inside an indexed universal life insurance policy, at least insofar as we've experienced how values accumulate with indexed universal life insurance policies over the past couple of decades. A 5% rate of return is more than within the range of reasonableness. And as an aside, if you're looking at these numbers and thinking $35,000, that's a lot of money, these things scale up and down. So we can accomplish the same thing with $10,000. Or if you have a lot more money, we can accomplish the same thing with more than $35,000. But 5% net of all expenses and taxes is the result that you could achieve, in this case, with the indexed universal life insurance policy. But let's look at what happens when we try to inflate the death benefit to hit the target of $2 million outstanding at the beginning of the policy. So now we have an indexed universal life insurance policy in force with a $2 million initial death benefit, same $35,000 planned per year premium. And if we go down to year 20, after paying $35,000 per year for 20 years, we have accumulated only $960,484. Our rate of return has dropped to 2.92%. That's a substantial decrease in rate of return. That's $261,000 fewer dollars than is the case when we put the policy in force correctly, where we minimize the death benefit to cut out all the expenses. Now, increasing the death benefit unnecessarily on a cash value life insurance policy will pay me, the agent, a lot more money. But there are several things you can do to pay me more money that will not result in you losing $261,000, and I would strongly encourage you pursue those things. And it should be abundantly clear at this point that paying an additional $980 a year for term life insurance will also be a much more productive thing from the standpoint of accumulating values and ultimately increasing your net worth than trying to increase the death benefit of the cash value life insurance policy. And you might even decide that you're going to deduct the term premium from the planned amount going into the cash value life insurance policy. So the net payment to the cash value life insurance policy is just $34,020 each year. And if you did that, the rate of return is not going to change. We can still accomplish the same rate of return. I mentioned earlier, these things scale up and down. So after 20 years, you'd have a little under $1.2 million at that point because you paid fewer dollars into the cash value life insurance policy. The exact number is about $1.187 million. But you would have had the $2 million death benefit the entire time. And what's more, the death benefit on the cash value life insurance policy does increase every single year. In fact, by year 22, you have $2.1 million in outstanding death benefit, which is more than you started out with. And that death benefit will continue to increase year over year. Now, we've talked a lot about cash value, but some of you might be wondering, well, what if I just need permanent death benefit? And that is a totally different discussion. One where cash value becomes almost inconsequential because individuals who need to put a specific amount of death benefit in force typically don't care about the cash accumulation of a life insurance policy at that point. The mission critical objective is a certain amount of death benefit, and there are policies that we can use that sacrifice the accumulation of cash value to provide you with a much lower out-of-pocket expense for permanent death benefit, and that is generally the right way to go for permanent death benefit situations. But the topic of just how much permanent death benefit you need is definitely a subject for a different day. So the real question in all of this is not how much cash value life insurance do you actually need? It's how much money should you be contributing to a cash value life insurance policy? And the answer to that is circumstantial. It's going to involve some evaluation of your circumstances to arrive at the right number. And I've been doing this for nearly 20 years and can tell you that there is no real good rule of thumb, a percentage of net worth, a percentage of how much you're saving in general. Everybody tends to be a little different in terms of their preference here. Those who are more risk averse are going to allocate more money to cash value life insurance. Those who like to be a little more risk on about things are going to contribute less to cash value life insurance. There are several different ways to think about this, and we should probably address that in the somewhat near future. But there's also a group of people out there who will say none, absolutely none is the right amount that should be contributed to cash value life insurance. And for those people, I say, good for you. You keep doing you.